fundsupermart.com.
Hi Stephen, what has the global property sector performed since the great financial crisis, and what is the outlook going forward?
I think it's important to put it in perspective in that the bottom of the global financial crisis we saw pretty dramatic stock price falls, and really since 2009 the global property securities markets performed extremely well. They're up around about 300% over those 5 years. But I think a better way to look at it is to look at it on a through-the-cycle basis, in that the falls were quite dramatic, but the price rises subsequent have been very good. So the market has actually performed very well. We've seen limited amount of supply of building globally since the financial crisis, and that has meant as economies have started to expand again, especially developed economies, at a slow grinding pace, that has created net demand, and with limited to no supply of commercial investment grade properties coming on board, the properties are also performing well and occupancies are up.
What are the implications of rising interest rates on the global property sector, and what measures are available to the First State Global Property Investments Fund to mitigate any negative impact?
Well, rising interest rates are going to have a material impact on all financial assets, including real estate. What quantitative easing has done in countries like the US, the UK and Japan, as it pushed long-term interest rates down to historically low levels and inflated all financial assets, that's not sustainable over the longer term. And as interest rates, especially the long end, does normalise over time, we believe that will put pressure on these financial assets. The counter to that is we'll probably see yields or capitalisation rates move out as interest rates move out, but the cash flow growth that should be coming from the assets, given the limited amount of supply and that occupancy levels are high, should be somewhat of a counter to those capitalisation rates that are moving out.
With such a wide investment universe, how does the fund select candidates for its portfolio? What factors or indicators do you look out for in a property security?
We look at a whole range of factors. We do our own proprietary forecasting. We're typically constructing portfolios on risk-adjusted total return expectations. We're not wedded to benchmarks as a basis for constructing portfolios or selecting stocks. So it's really about allocating our capital into those REITs and real estate operating companies that are going to deliver us the highest risk-adjusted return at any one point in time. And that could be anywhere. So on that basis, if there's a series of those sorts of investments sitting in one particular geographic region or one particular sector type, we'll start to see concentrations forming in that sector type or in that geography. Where we sit at the moment, we're finding a lot of pricing anomaly in the emerging markets. And clearly we've seen a large emerging market sell-off. We've seen money flows go from emerging markets into the US dollar trade as the US dollar has improved. And we've seen long end of the interest rate curve move up a little bit. US Treasuries have moved up from sort of 1.6 to 2.75 to where they sit today. And that's left good pricing anomaly in high quality real estate in some of the emerging markets. Brazil has very high total return expectations for high quality real estate, but it's in a rising interest rate environment. And if we look to places like Hong Kong, where we've got fiscal austerity or austerity measures associated with the housing market, and a reasonably benign growing economy, very low unemployment, retail sales slowing a bit, we've seen high quality real estate performing okay. Occupancies are high. We'll probably get a little bit of office market growth over the next few years, and my feeling with regards to the retail sales in the malls is they'll probably perform quite admirably, but just not as well as they've performed over the previous 5 years where retail sales were very high. So that's where we're seeing the greatest price anomalies at the moment globally.